Hello and welcome to Commodity Culture, where our goal is to make you a better investor in the commodity space. My name is Jesse Day. Before we dive in, standard disclaimer, nothing here is investment advice. Do your own due diligence. And today's episode is sponsored by ARC Silver Gold Osmium. They offer personalized service and competitive prices with no minimum purchase for silver, gold, platinum, or osmium. Here's just some of the comments left on this YouTube channel about ARC SGO and owner Ian Everard. Have bought from ARC, good source and price. I cannot say enough good about Ian and his company. He is the most honest individual I could find in order to buy precious metals. If you are looking to buy precious metals, I recommend Ian at ARC Silver. He is a straight shooter. So go to arcsgo.com and contact Ian Everard today at 307 264 9441 or by email at ian@arcsgo.com and make sure to tell him that Commodity Culture sent you. And today's guest is the founder of Heresy Financial, where he educates viewers on money, investing, and the economy. We're going to discuss the dangers he currently sees in markets and the global economy, along with getting his thoughts on commodities and how they could be poised to perform. It's Joe Brown. Welcome to the show.
Hey, thanks so much for having me.
Yeah, thanks for being here. It has been a long time since we've chatted. So I want to start with something that you were posting about recently, both on Twitter and your YouTube channel, which is the reverse repo facility. Now, firstly, could you break down what the reverse repo facility is, why it exists, and how it could be presenting a risk to the economy right now?
Sure. Yeah. So I'll give a really broad overview, and then we can dive into any details if we need. So banks, at the end of the day, they'll either have extra collateral, but they'll need cash to meet their daily obligations, or vice versa. They'll have extra cash, and so they'll work with each other every night. And the ones that need some cash will say, "Hey, I other banks, anybody, I need some cash overnight. I'll give you some collateral like treasuries. We'll swap it." And so I get the cash from you, you get the treasuries, and I promise to repurchase it. That's where the word repo comes from. I promise to repurchase it from you tomorrow or at some point in the future. Uh, so that's how the repo markets work. Back in when the financial crisis happened, a lot of people are not aware the repo market blew up because everybody that night went to go get cash from overnight repo markets. And so they all took their collateral and they said, "Hey, I need some cash." But all the banks were doing the same thing. Number one. Number two, all the collateral was mortgage-backed securities. And once everybody realized these things were bad, nobody wanted to accept that as collateral anymore. So the rate on cash spiked because nobody had cash. Everybody had the bad collateral that nobody else wanted. And so the Fed intervened to rescue that market. That's all history. Fast forward to September 2019, the interest rate, the repo rate spiked again. So everybody was scared, like, "Hey, is there bad collateral in the system again?" Well, what turned out, what was happening was the collateral was good. It was all treasuries, but all the cash had been drained from the system. So all the banks came to each other and they said, "Hey, we need some cash," but everybody was doing the same thing. Nobody had cash. Everybody had collateral. So the rate on overnight cash spiked. And that was in September of 2019. That's when the Federal Reserve started, they entered into the repo market themselves. They printed the cash and they said, "Okay, we'll be the person that provides the cash since none of the banks have cash. So give us your collateral. We'll give you the cash overnight so that those repo rates aren't high. Otherwise, if banks don't get the cash that they need overnight, they collapse overnight." So it's like a pawn shop, literally. Like it's a big complex pawn shop. And so that's the regular repo market. And when the repo rate spikes and things like that's like a lack of liquidity in the system. And at that time, we had a lack of liquidity because the U.S. government spending had gone through the roof, borrowing had gone through the roof, and so the government had sucked all the liquidity out of the system. There's just not enough liquidity in the system. 2020 happens, all the money printing happens, great excuse to, fix that issue that was happening before. They called it not QE before when they were intervening in the repo market because they're like, "Hey, it's just the repo market. It's just short term. So it's not quantitative easing." So everybody called it not QE. When COVID hit, they printed all that money. The opposite problem started, which was number one, the Fed printed $3 trillion, gave it to the government to spend, but they did that by buying a bunch of existing government debt off the market. And so not only did the collateral in the system, just a lot of it disappeared, $3 trillion worth just disappeared out of the system, but also now you have a bunch of cash. So all that cash that the government spent into the economy, that goes into bank accounts. For a bank, a deposit is a liability because now they owe that money to you. So it's an asset for you because you have somebody who owes you money, the bank, but for the bank, it's a liability. And so they need to get an asset to offset that liability. If they just keep the cash and they owe it back to you, they're just wasting money on the lights and the buildings and the employees' salaries and all that. So they got to do something with it to make money. In other words, they have to get an asset to offset that liability. Usually what they do is they go buy treasuries. But remember what I just said, all the collateral had been sucked out of the system. And so what would have happened was banks would have used all that cash to go buy like T-bills, short-term government debt. If they did that, it would have pushed rates negative. So what the Federal Reserve did was they said, well, we've already been intervening in the regular repo market. We'll open up a facility called the reverse repo facility, which instead of us giving banks cash and taking their collateral, we do the opposite. We give the banks the collateral they need and they give us the cash. And they said in order to incentivize banks to use this institution, we are going to pay 5 basis points above the lower end of the federal funds rate. So basically, just enough to make it attractive compared to what the federal funds rate is. So whatever Fed sets interest rates at, there's a range. The bottom end of that range, they pay on the reverse repo facility 5 basis points above that, which is 5% of 1%. At the beginning, that's not a lot of money, but they started to raise rates from there as they were trying to fight inflation. And so by the end, they're paying 5.3% on the reverse repo facility on any cash in there. So it sucked $2.3 trillion into that reverse repo facility out of the system. Because again, it's like all this cash, banks are like, what are we going to go do with it? And they're like, well, if we put it in T-bills or treasuries, we're not going to get a very attractive rate. But if we give it to the Fed, we're going to get 5.3%. Risk-free, no risk of default. This is the Fed that prints the money, so they can't default. It's overnight, so there's no time risk. It's like literally the best thing in the world, the best deal in the world on what to do with your cash. So money got drained out of bank accounts specifically and put into money market funds because that's where the majority of it was going into the reverse repo facility from. So financial institutions everywhere were just pouring money into this because it was the best place to get a risk-free return on your money. In April of 2023, May of 2023, that equation changed and suddenly money started draining out of the reverse repo facility again. What changed? T-bill rates finally got high enough. So cash is always looking for the best risk versus reward. That was the reverse repo facility. But once the US government they tapped out liquidity again, they started borrowing more out of the system. They have to pay higher and higher rates in order to attract more cash. The rates that they were paying on T-bills, which is the shortest term debt, finally got to a place where it was attractive enough for people to decide, I'm going to take it out of the reverse repo facility and give it to the government through T-bills instead. And it's like, 5.35 to 5.4%. So every time the government borrows with T-bills, it sucks a little bit more money out of the reverse repo facility. That paused for a while in April and March of this year because of tax season. So during tax season, the government's collecting a lot in taxes. They don't have to borrow as much. And so there's not as many T-bills getting issued. So that money stays in the reverse repo facility. And within the next month or 2 months, that drain is going to continue as the government will then have to start issuing more debt again, rolling over more debt again as well. And that account will probably hit zero.
Wow. Incredible breakdown. Very understandable despite its complexity. So thank you for that. I do want to touch on a tweet you recently made, perhaps timely as there was a Fed meeting today. You tweeted, Powell just said if inflation persists, the Fed can keep rates where they are for as long as needed. And yes, they can bring back QE without lowering rates higher for longer. So maybe you could first give us your thoughts on the Fed meeting today, Powell's comments, where you think Fed policy is headed, and explain how could they bring back quantitative easing without lowering rates?
Yeah, so the Federal Reserve generally uses two things to carry out its monetary policy. They use interest rates and their balance sheet. So interest rates, when they change interest rates, it's not like they're directly changing mortgage rates or car loans or credit card rates or mortgage treasuries or anything like that. They're changing the federal funds rate, which is the overnight rate between financial institutions. And they're going to intervene in that market anytime it would naturally get above their range or below their range to keep it inside that range. So they'll do their buying and their selling that they need to keep it within that tight band. Since that's an overnight rate, then in normal times, I mean, that has an influence on the longer term debt, because the likelihood that somebody is going to lend to the government for 30 years at a lower rate than they can for 5 years, then this is a normal environment. Usually that's going to be a higher rate. And so when the Federal Reserve lowers and raises their short-term, their overnight interest rates, the Fed funds rate, that has an impact on the rest of the yield curve. Now, the reason why they lower and raise interest rates is to either stimulate the economy or to try and pull back and throttle back the economy to fight inflation. Now, I want to be clear. I'm not saying here that any of this is effective or correct or right or moral or that I agree with it. I'm giving an explanation for what they do, why they say they do it, and the mechanisms that they use to justify what they're doing. I'm not saying I agree with the accurateness or the effectiveness of any of this. And so they'll raise and lower interest rates to fight inflation. So they'll raise interest rates. That makes it harder to get debt, which means, or more expensive, which means more money is going to service debt instead of being used to spend on other things like hiring or consumption. And it also means that debt gets paid off. When debt gets paid off, that actually reduces the money supply, all else being equal, because when debt gets paid off, that's dollars ceasing to exist, because dollars come into existence through loans being made. So when loans are paid off, that money ceases to exist. And the lower the money supply, the lower prices, again, all else being equal. So that's the mechanism that they're trying to use to change inflation. In that tweet that you mentioned, I talked about how the Federal Reserve said, hey, inflation is not down yet. It doesn't look like it's coming down to where we want it to be. We're not going to change interest rates until the data for inflation justifies it. And that was a couple weeks ago, I think, maybe a month ago. And today, as of the day that we're recording this, the Federal Reserve just had their latest FOMC meeting and press conference. And he reiterated that exact same thing, that they're not going to be lowering interest rates until the inflation numbers are coming down enough to justify lowering interest rates. They don't want to put fuel back on that inflation fire, and it's already roaring pretty hot right now. But in history, normally their balance sheet, their other tool, has moved in lockstep with interest rates. So their balance sheet is basically like, you can think of it like their brokerage account. Like, it's where they hold all the assets that they purchase. The only difference is they create the money necessary to buy assets on it. So they don't need to like make money first and then use that money to, they don't need to earn money first and then use that money to buy assets. They just create the cash necessary to buy the assets that they want to buy. So their balance sheet is comprised of treasuries all across the yield curve and mortgage-backed securities. Over the last, 2 years now, they've been shrinking their balance sheet. And so as the government pays off debt that is held by the Fed, which means they're paying back the Fed money that they borrowed from them indirectly, those dollars just cease to exist and that debt ceases to exist. So their balance sheet declines because that cash goes to pay back the Fed. That treasury ceases to exist. And so now the total value of their balance sheet shrinks because those dollars they're just destroyed. The reason why I said that they'll keep interest rates high while also bringing back QE is because of the pickle that the federal government is in right now. Right now, the federal government pays $1.2 trillion in interest alone annually on its national debt. That's like 30 to 40% of total tax revenue. At current interest rates, in 1 year, that number will be $1.7 trillion. So they're rolling over a ton of debt because a lot of the government's debt is short term. So the more they roll over, it used to be cheap debt. It was borrowed back when interest rates were 0, 1, and 2%. Now it's expensive debt. Every time they pay it off by borrowing new debt, they're paying 4 or 5% for that new debt. So just the interest alone on the national debt is quickly becoming the largest line item on the budget. It is at the current rate, it will quickly become unaffordable. and they're draining liquidity from the system. At the same time, what the Federal Reserve is doing right now is every time the government pays back some of that debt that is owned by the Fed, it's sucking money out of circulation because the Fed's not rolling it over. And so what the Fed just said is what I tweeted about a couple weeks ago. They are right now going to slow the pace at which their balance sheet is declining by. So let's just say they keep their balance sheet even. And let's say they have $5 trillion worth of government debt. If that stays even, that means every time the government pays off debt to the Federal Reserve, like one of those bonds matures, for the balance sheet to stay even, the Federal Reserve has to take that cash and reinvest it by buying new government bonds, which means that cash that the government pays back to the Fed circulates right back to the government. And so any debt that the Federal Reserve owns basically doesn't get paid off, even when it's just getting rolled over. That cash just gets circulated right back to the government. So the Federal Reserve is making one step closer to that. They're saying we're going to slow the pace of our balance sheet decline right now. Next step is we've declined our balance sheet enough. We're going to stay steady. Next step after that is we're going to start increasing it again. And they'll take those steps as the federal government continues to have to pay more and more on interest, continues to struggle with their auctions. When you look at their auctions for debt, they've been getting worse and worse and worse. They're struggling with raising the money that they need to spend. So the Federal Reserve will continue making those steps so that the government gets the money they need to continue to survive and not default, while the rest of us are just going to keep on paying higher and higher interest rates. And the kicker is, as the government gets more and more of its financing from the Federal Reserve, as it takes these steps, that's more money being printed into existence, which increases the money supply, which pushes up prices, which means inflation keeps on going higher, which means interest rates will stay high or keep on moving higher. So we've got interest rates moving higher, and we've got inflation moving higher for the rest of us, but the government will continue to be funded by the Fed.
Is a higher for longer interest rate environment bearish for gold in your view? We've obviously seen it reach all-time highs in a higher interest rate environment, which is contrary to how most people think things should play out. A lot of people point to catalysts like record central bank buying, geopolitical turmoil, etc. I'm wondering what your thoughts are on gold, if you think, because one of the catalysts everybody talks about when it comes to gold is the Fed's going to be forced to cut. And then when that happens, gold's going to take off. It seems to have done quite well without that catalyst. I'm wondering what your thoughts are just in general on the gold space and how a higher interest rate environment might affect the gold price.
That narrative that you described is very delayed, and it doesn't track well with history. So when you look at the move that happened in gold from let's say 1400 up to like 2100 that took place in 2020, there was zero inflation that happened during that time. In fact, pretty much like to the month that the gold move stopped and started moving down, when that gold bull market ended there, that's when inflation actually took off. And so gold anticipates inflation, those inflationary moves. So more than likely, if the Federal Reserve is going to cut rates in the future as a result of inflation coming down, the move will have already happened in gold. And we're kind of already seeing that play out right now. It's up at, 2,500 or 2,300 or so. I haven't checked it today. It kind of sniffs out that future inflation. So the higher for longer narrative that I've been talking about for a long time is a direct result of the inflation. And so that's in my opinion what gold is sniffing out right now. And so it doesn't matter if interest rates are high and moving higher. What matters is the debasement. What matters is the inflation, and that's, in my opinion, what gold is sniffing out right now.
You released a video on your channel recently titled "A Second Wave of Inflation is Coming. Same thing happened in the 1970s." In the 70s, we saw a major commodity bull cycle with gold and commodities vastly outperforming stocks, bonds, and the dollar. Do you expect something similar to occur this time around?
I would not be surprised. I'm maintaining fairly, a fair amount of diversification between those asset classes. So I'm not heavily betting on one versus the other, because typically what happens, like not just looking at the 70s, but looking at many inflationary cycles, Assets of all kinds continue to rise as a result of inflation, and usually they move up ahead of inflation in goods and services. It's the Cantillon effect. I'm sure most people who are listening to this are aware that when money is printed, typically it goes to the government first. And then when it's paid out, it moves asset prices first. And then from there, it moves prices of goods and services. And then from there, pushes up on wages. And so that's the way that it generally flows. And sometimes those asset classes are different. Now, I will say that when you look at the long-term history of the value of commodities versus, like paper assets in the stock market, it does seem like we're like, pretty primed for a good long-term bull market in commodities, or at least outperformance compared to stock the stock market. We'll see. I'm not heavily betting on one versus the other. I'm putting bets on both horses because they're both going to be moving the right direction.
There's a lot of people pointing to the broad market, to the Magnificent Seven, this handful of stocks that's holding everything up, it seems. And they're saying that it's due for a really steep correction. I'm wondering what your thoughts are there, because it does feel like we're in a situation similar to what Benjamin Graham describes in The Intelligent Investor, when he talks about when it's time to step back and maybe be a little more rational and not throw money or chase gains. And at these levels, these valuation levels, the market tends to be due for a correction. Is it different this time around? Is there something unique about this market environment that could allow the broad market to continue to grind higher?
Yeah, I mean, when you look at this is an extreme example, and I'm not saying this is what we're going through right now, but when you look at stock markets in countries going through hyperinflation, the valuations are like they're just meaningless because everybody's buying something in order to prevent debasement as much as possible, and so the traditional valuation metrics matter less and less the more you have debasement of the currency. The more sound the money, the more those traditional valuation metrics matter, because people are actually concerned about real profits and making a real return on their money. And the alternative is just safe savings that doesn't get debased. And so the threshold for making profits and risk versus reward is much higher. But in an environment where all you're concerned about is making sure that you don't lose to inflation, that skews everything. And the more debasement that happens, the more those numbers get skewed. And it still works. Like stock markets, like if you look at the Venezuela is a great example. Just Google Venezuela stock market chart. There were some periods of time where it fell, 20, 30, 40, 50%. Overall, it went up. Now that maybe you didn't maintain your purchasing power completely, but you did a lot better than holding the currency, right? And so that's what assets do. And so there's definitely very valid arguments that all of the valuation metrics, when you look at equity markets today, when you look at a lot of different asset classes, they're wildly overvalued and should crash. But what will happen and should happen are two different things. And so sometimes you have to step back and ask, well, why is it going up? Why are people buying? And it's like, well, maybe it's the best alternative to just keeping it in a bank account and just maybe even not even breaking even with inflation. At least you're gaining a little bit. On the other hand, I will provide like a devil's advocate to that. I think the chances that you do get like wild swings and heightened volatility and flash crashes go higher and higher as this continues. Like I said, when you look at some of those stock markets in countries that have gone through severe hyperinflation, you still get big drawdowns, you still get big crashes along the way. And so, like, personally, even if the valuations don't come down to where it seems appropriate, I would be taking those opportunities to buy more. Maybe it's not at an objective value or discount, but relative to what it's doing and relative to what the currency that's being denominated in will do, it's probably a very good deal.
Yeah, that's an interesting perspective I actually hadn't heard before. The debasement of the currency kind of drives people into these assets. Um, When looking over the commodities complex, first I'd like to get your thoughts on silver. Do you see the same catalyst driving gold, potentially driving silver as well? And are there any other commodities when you look out kind of over the whole commodities complex that you think might perform especially well in the years ahead?
Yeah, I like silver. I'm not opposed to silver at all. The thing about silver is that it's the of any like a lot of people will look at silver and think that it's a monetary asset, and I disagree with that. The amount of value, and when you see what changes the price of silver, it has very little to do with its monetary value anymore. And that's not just something that has been happening within the last 40 years or so. The monetary value of silver has been on the decline for a couple hundred years now. Really, the monetary value of silver came in as deflation continued to happen to the world through natural progress, like good deflation. Gold got more and more valuable, and so it became less and less useful for small purchases. And so, less valuable metals became more valuable, or more useful, I should say, as a medium of exchange for small transactions. So we use like quarters as change for dollars. It used to be, you use silver as change for gold, right? So that's what I mean by that. And technology really replaced that. And paper is a technology. I mean, I'm not talking about like the government's abuse of paper money, but paper as the exchanging of ownership of gold as money through the exchange of paper. That was a technology that severely diminished the usefulness of silver as a monetary metal. And that has continued until today, when money's not backed by metal at all now, and so mostly what impacts the price of silver today is its industrial usefulness, its industrial value. And so all that being said, I do like silver, and I just don't want to imply. I've heard a lot of people talk about how silver is going to 100 and it's going to be useful as money in exchange. I don't think that's ever going to be the case anywhere in the future, unless we have like a nuclear fallout across the world or something like that. So silver is definitely, in my opinion, I'm very bullish on it. It has just broken out of a like 2-decade long consolidation pattern. It is looks like it's embarked on a new bull market. I'm bullish on it all the way up to at least 50 and beyond. And so I do like silver. I want to hear. I need to be reminded of the next part of your question, though, because you asked about silver and something else, and I forgot the other part of your question.
Any other commodities that you're looking at the moment that you're particularly bullish on?
Yes. Uh, I would say so. This is one that I've recently been taking a look at, and I haven't built a position in it yet, but I'm very close to it, and that is natural gas. Natural gas is one of those that seems to be, at least like its value relative to oil, seems to be very undervalued at the moment. There's a very bearish narrative against natural gas right now, and um, I think it's very possible that is overblown, and we could see a pretty big move up in natural gas over the coming couple of years. I'm starting to get very bullish on natural gas. Haven't taken a position yet, but I'm getting very close to it. The next one that I really like right now is uranium. It's already begun, like probably 9 months ago. It started its move up, and so it's a little bit too late to get in as an early mover. However, I think that uranium has very good long-term prospects here because, number one, uh, uranium buyers are not price sensitive, so they're going to have to buy the same amount of uranium no matter what. Right? Like you can't just shut it down and be like, I will buy some more uranium when it comes down in price. It's like that's not an option. Number two, the above ground supply is not being replenished at the same rate that it's being purchased. So the supply that is currently mined is being drained. Now, uranium being over right around the price that it's at right now, that's where a lot of miners start to come back online where it's profitable. And so that's why it's kind of stalled out here a little bit. But the other reason why I'm bullish past this point is because it's becoming very clear over the last, I would say, 2 years that the world is moving to nuclear. We're about to enter into another nuclear like renaissance that we should have moved into in the 70s, and the oil industry kind of secretly got behind some negative propaganda about it. And if you look at both the left and the right, Democrats and Republicans, when you look at countries around the world, when you look at the population overall, people are becoming more and more educated about nuclear and waking up and realizing like, oh, it's got the lowest death rate of any energy production in the entire world by like an unmatchable margin. Like it's incredible. Like something like only a couple hundred people in history have ever died from nuclear energy production. And it's like people die from that every year, a couple hundred people a year from installing solar panels and windmills. It's like safest in terms of death. It's the only energy production in which we sequester the exhaust or the waste from the environment. All other energy production, it gets released back out into the environment. It's the most energy dense. You take one like square mile, and that produces as much energy as like thousands of square miles of solar panels and wind farms. It's insane, all of the benefits. I have barely even scratched the surface there, and all of the things that people are afraid of are either not true, they learned it from The Simpsons, or they're problems that were dealt with and there's a solution to since like the 80s. So people are waking up to that. We're starting to see policy change towards that, and the real big kicker is that with a lot of new energy demand from large corporations, especially for like server farms and AI, and probably Bitcoin as well in the future, means that we're probably going to have a big corporation lobbying effort to deregulate nuclear. We already saw Amazon just purchased a nuclear facility just to run one of their server farms. And so we're probably going to see a big push from corporations, large corporations, to lobby for it, and that'll kick off the next big surge in nuclear. So I'm very bullish on uranium.
Yeah, you're definitely preaching to the choir on that one. And it is kind of an issue, you're right, the kind of negative programming that's gone on about nuclear. It's funny, here in Serbia, I had a couple of Serbian friends over, and they looked, as they had sad faces, they informed me, oh, our government's thinking of building a nuclear power plant in Serbia. And they were surprised at my reaction, because I was like, great, that's so awesome. And they were like, what? And then my wife was like, here we go again. I went into my like 20-minute, 30-minute spiel about why everything they've learned about nuclear is incorrect. And as you mentioned, those same statistics, the lowest rate of death per energy production source, and all those things. I definitely think the tide is turning, but more education needs to be done for the general public at least. I'm wondering, now that we're on the topic of energy, what do you make of the whole push for renewable energy and carbon neutrality, net zero, all of this sort of stuff? It seems fossil fuels or hydrocarbons, whatever you want to call them, are being demonized. And this has led to an opportunity in things like natural gas. And I think oil as well. A lot of the oil stocks are still, I think, far below their intrinsic value due to underinvestment. Where do you see this whole push going, this plan to electrify the world? Because the people that are implementing it are either sociopaths, like these politicians, at worst psychopaths. I think they're completely ignorant. They don't know what they're talking about for the most part. Am I off base here? What are your thoughts?
Yeah, there's a saying: never attribute to malice what can be attributed to incompetence. And so I would say probably 90% of the time it's incompetence. Just like even like the average person, you ask them what's safer, solar panels and wind or nuclear, and they're all going to say solar panels and wind. When objectively looking at the actual risks and the death rates, it's the opposite. So what I don't think, if I had to guess, I would say that it's probably already peaked. You cannot violate fight against the laws of physics for too long before, nature kind of snaps back at you. And when you waste resources in pursuit of something that is not profitable, then you run out of resources to waste. And so the big push to electrify the world, EVs, the green push, it's not renewable. It's not reliable. It's not energy dense enough to provide anywhere near the energy that we need. Despite the amount of sunlight that hits the world, the amount that we can actually capture without changing local environments and devastating local ecosystems, and then even just replenishing those after their lifespan of 20 years. It's like it's not net positive in terms of its cost or its impact on the local or broader environment. And so you can only waste so many resources in pursuit of something like that before you run out of resources to waste. And it's kind of like a similar idea to like capital allocation. The reason why Warren Buffett has billions and billions and billions to allocate is because he's done so well that it feeds back on itself and gives him more assets to be able to reinvest and reallocate. And if he had been bad at capital allocation, he would have nothing to invest and waste right now, right? So it's the same kind of thing. And competition steps in then as well. So there are places that are currently making a push towards nuclear, that are making a push towards more drilling, more oil, more everything, more energy. And those places over time will outperform the places that are saying, hey, we're going to use the subpar, more costly, less efficient overall forms of energy, like the green agenda. And that's where the resources will then flow. So I'm optimistic actually about this because I think it's the worst of it is kind of behind us. I think that the public sentiment is changing a little bit. When you look at like the EV push, it just completely failed. Like Ford cannot sell all their Mustang Mach-E's and their Ford F-150 Lightnings. They're just sitting on lots. Nobody wants them. Not only that, but in many places, if they were to sell all of them that the government was trying to have them sell, there'd be no place to charge them. Electricity prices would skyrocket, and we already have grid issues. And so there's big pushback right now. A bunch of the car manufacturers are now trying to push the government and say, please relax these regulations. We can't build these things anymore profitably. Nobody wants them. They're not selling. We're losing money hand over fist. And so you can only push against that door so much before it just stops working. Many of the car manufacturers have completely abandoned their EVs now, and they're saying, hey, we're going to go back to hybrids. And so anyway, yeah, it's something that I think is so unsustainable that it's already peaked, and we're probably right now in that entering into that phase of time where it's like the swing back towards just what works, like like oil and fossil fuels, which means that because the underdevelopment, prices are going to be a lot higher for a while, and then those higher prices will bring profits back in and allow new development, and then we'll swing out the other side. But I am optimistic about that. I think that's a better direction to go.
I think one of the main themes in general when it comes to markets and the economy these days has been uncertainty. A lot of people believe we're in uncharted territory here. Let's end on getting your thoughts on ways that your average retail investor can protect their wealth in the face of everything that's going on. Obviously, we don't give investment advice here. We talk about sectors we're bullish on, and people need to do their own research. But what do you think are some ways that your average person out there can protect their wealth from the debasement of their currency, from all this out of control government debt? What are your thoughts?
Yeah. So there's a couple of things. Number one, you want to make sure that with like your cash savings, you're getting as high of an interest rate as possible so that you're not losing to inflation. Cash savings are important, by the way. Everything we were talking about earlier about how people dump money into assets because they're losing to inflation on like cash is like, that's a logical response. I don't think it's the best response for 100% of your portfolio though, because when times get tough, you sell what you have to, you don't sell what you want. And that's why crashes happen, because people get over invested, then they lose their job and they need to pay their bills. So they have to sell everything, all their assets when they're down 50%. And everybody's in that same boat, which is why they're down 50%. And so you don't want to be in that boat. You want to have enough cash savings to be able to lean on in hard times. And hopefully being able to take advantage of assets when they're on sale during those hard times. And so you can get good rates on your cash through things like T-bills or money market funds or high yield savings accounts, close to the rate of inflation. Now, with your assets, with your investing, I would say do a little bit of research on the assets that historically protect you from inflation well. Those would be things like, in my opinion, gold, real estate, as long as you, it depends on the country that you're in. In America, you get the tax benefits and the 30-year fixed rate mortgages. It's really hard to beat that because, and then tenants pay your debt off for you. You grow in the equity. So you're growing your wealth in multiple ways with real estate. And you don't want to buy it just for the asset. You want to make sure you're getting a good deal. So it might take a little bit more work now to get a good deal than maybe a couple of years ago, but it's still a good asset class. And then equities as well. Now, I will say that when you're investing in the stock market, especially when things are super overvalued right now, it's very valuable to learn a skill like trading options because you can hedge your portfolio. So let's say you do just want to buy, put your whole account into SPY, which I wouldn't recommend, but let's say you did want to do that. That's completely fine. Buy some out of the money puts on it for the next year. And you're going to spend a little bit of money on that. But if the stock market crashes, then those puts that you bought are going to at least hedge and in some cases even make you more money on that crash. And you can use that to, reinvest or just have some extra cash. So learning a little bit more advanced investing skills like trading options is something that I think is becoming more and more important. As long as you don't do the types of trading that is basically gambling that opens you up to unlimited risk. That's the opposite of what we want.
Yes. Well, I think that's a great segue into discussing you've got a university, you've got Heresy Financial University where you teach about some of these things, as well as the Heresy Finance YouTube channel. Could you fill us in on both, where people can find them, what it is you do there?
Yeah, so my YouTube channel and my Twitter and my social medias, those are kind of where I put out as much free information as possible on, understanding how some of this stuff works. And then in terms of the implementation of looking at the volatility in the stock market, let's say I do want to hedge against that kind of stuff. It's a little bit more in depth, especially if you've never learned options or trading options before. So I have a whole course on options. I have a whole course on, navigating the retirement account system and bulletproofing your portfolio and, all sorts of different things that are very in depth that you need to learn if you want to go deep into this stuff. So it's not really useful for that to be put up on YouTube. It's, hours and hours and hours of very, very intense stuff. So that's what I built Heresy Financial University for. It's a monthly membership, no contracts, cancel when you want, consume it for as long as you want, go through the modules, learn all the skills. We do live coaching calls every month, and there's a community and some other bonuses and great money making features in there as well. So that's what I do on the paid side, and then everything else is out on YouTube and Twitter and stuff.
Great. Well, I'll put links to the YouTube channel, the Twitter, as well as Heresy Financial University in the description below for people who want to check that out. Thank you so much once again for coming on, Joe, and sharing your knowledge with the audience.
Yeah, thanks again for having me. It was fun.
And thank you for joining us today. As a reminder, this episode is sponsored by ARC Silver Gold Osmium. Visit their website at arcsgo.com and contact the owner, Ian Everard, today at 307-264-9441 or by email at ian@arcsgo.com for all of your precious metals needs. And be sure to tell him that Commodity Culture sent you. And I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.